Hi, my name is Amy. Thank you very much for watching, and let's make some amazing financial commentary together. So, this is for entertainment purposes only, so if you're entertained, please like and subscribe. I really appreciate this. And today I was asked to review the AI bubble holding up the US economy, a story built on debt, and I yes, Pi, I am gonna click on the video. You can help me.
AI is the most powerful technology shift in our lifetime.
Yes. Okay. Is the AI bubble holding up the US economy a story built on debt, loots, and unsustainable spending? I'm assuming this is about the concerns about the AI bubble, and I don't doubt that it's coming. I guess now I'm not so insanely into the AI stuff. These things are cyclical, right? So if you think in the long term it's going to do well, I don't know when this is going to end, this cycle, and then it's going to go be crap, and then it might be crap for 3 or 4 years, and then the cycle will begin again. But, I think just right off the bat, like, it is possible that this bubble will. Well, okay, so when people expect a crash from something, it usually doesn't happen. So, crashes usually happen when nobody is expecting it. So Saja boy, you're you're really staring into the screen today. Okay, let's watch the video.
NVIDIA also hitting a fresh intraday high. That's today's leader. As oil once powered industrial growth, semiconductors, they're now fueling the AI boom. So right now, the market is placing its bets accordingly.
It's transforming productivity, making advancements in science and medicine, changing the way we do business, and rewriting the rules of investment. Now, some people call this the fourth industrial revolution. If you've been following the news at all, you would have come across seeing NVIDIA, the company that makes all the GPUs that power these AI models, have hit $5 trillion this cycle. To gain an appreciation for how large $5 trillion of market cap is, if we take a look right over here, you can see that NVIDIA is now larger than the GDP of all of the countries in the world except for the US and China. And these companies continue to capture upon this success and
So, I think my takeaway for like NVIDIA, Palantir, and AMD is that it's probably better to be in like the fund AI stocks that don't necessarily just have NVIDIA and Palantir, but is the entire like semiconductors and everything, because it's gonna suck when NVIDIA goes bad. In July 2024, when I was first getting into investing again, I was gonna go with the just being VU, but then I was looking at the market concentration and I was like, well, if NVIDIA goes down, it's taking the whole market with it anyway, so may as well just invest in NVIDIA. That's probably wrong thinking, but hey, it was a thought.
grow at such a large magnitude and scale. During this cycle alone, we now have more than 498 companies that are worth $1 billion or more, and 1,300 companies that are now worth over $100 million. So the Mag 7 companies, Tesla, NVIDIA, Amazon, Apple, Alphabet or Google, Microsoft, and Meta, they actually put in $1.7 trillion of revenue in 2024, making up 36% of the S&P 500. Now, to put that in perspective, every dollar that you put into the S&P 500,
it is so concentrated. So that's why a lot of people just invest in the Mag 7. They're 36% of the S&P 500 anyway. But if you do that, then I can't recommend anything because I'm not, a CFP or anything like that. But maybe try to find uncorrelated things like small, mid caps, value companies, whatever is your spot of tea. But it's even like if you do the NASDAQ, it's still very concentrated in tech. So there's always going to be concern because the economy is overweighted in these tech stocks, but the economies of scale is with these companies. And normally you would be thinking with the natural life cycle of a business that some of these would kind of go out of business because they're not relevant anymore. Like we've gone to Web3 or whatever. However, these businesses have become big enough that whenever there's real competition, they kind of just buy the businesses and start they just they just keep getting more brands. So I think for the Mag 7, they're going to be around for a while. Also, my sweater is super dirty because I had to take down the fences today because I'm getting new fences tomorrow. The ones that I had are cattle panels and very temporary. So we're getting ones with real cement and stuff. I just needed to take the old ones out. So it took me from 2 p.m. until 11 p.m. and it is now 11:30. So we'll try to get through this kind of quick. But yeah, the 7 companies, those are, it's making it a lot of over concentration, the S&P 500, which I think Hank Green had a video about this the other day, and I just wanted to tell him if you're that concerned about it being overweight, there is an equal weight S&P 500 index, so you could just buy that instead so it's not over concentrated.
For an index fund, likely 36 cents to 40 cents is actually going to an AI company. So our economy, our stock market is dependent upon AI to grow as of this very moment. And NVIDIA's $5 trillion market cap value is worth more than the entire stock market of Italy, the UAE, Spain, and the Netherlands combined. But here's the truth of what most people don't see. A huge portion of this AI boom is fueled by this circular money machine, a feedback loop between the AI companies, cloud providers, and chip makers that's starting to look dangerously like a bubble. But it's not exactly a 2000.com copy and paste, but it's something bigger. So in today's video, I just wanted to break it down.
I heard something about that, OpenAI specifically, they're getting funding from these big companies, and then they entered into a contract with AMD, but the AMD one is performance-based, so they're not just going to get 10% of the AMD. They have to achieve the goals.
Further and understand who the AI players are, where's the money coming from, explain a little bit of the circular financing loop between the AI companies, the debt that's hidden on their balance sheet and out of sight, and then finally, how could we use this information to make informed decisions going forward? So to get a really good understanding and grasp of this story, we first have to understand all the different AI companies that are involved. Now, group number 1 are the chip makers. So these are the giants like NVIDIA, AMD, and Intel. They make some of the most advanced chips within the world that run the AI companies and the computational models that are out there. Think of them as the shovel sellers in the previous gold rush era because they sell the GPUs. So in this case, these are the picks and shovel that will help all of the different AI companies, the mainstream AI companies, to run all of their different AI models. Then there's group number 2, the data centers, the cloud and infrastructure people. So these are your Microsoft, your Amazon, Oracle, and CoreWeave. We call them the middlemen, the capacity builders, because these companies buy those GPU chips, they build up massive data centers, secure gigawatts of power, and
It's nighttime, and they are Great Pyrenees. This is their job. They keep the predators away from my sheep. So we're not going to yell at my dogs for barking because that's what they do. But yes, it's interesting because, for example, Yilmaz's GPT-Y is about AI, but Chippy is about semiconductors. So you can think beyond just like the software and the large language models. There's different parts of this pipeline that you can invest in. I'm not sure if my dogs are going to stop and if we should wait or just power through.
And then finally rental compute to those AI companies. So you can think of them as the middleman of the AI economy. They are the capacity builders. And then finally, group number 3, these are the mainstream AI companies that you hear about all the time. So things like OpenAI with ChatGPT, xAI with Grok, and Google DeepMind. So what these AI companies do is they buy a large amount of compute from the clouds, burning through hundreds of billions of dollars, trying to run their AI models, always pushing the frontiers of their AI models into the next level. By doing so, all of these companies compete against each other, spend hundreds of billions of dollars by trying to become the top AI model. And the thing that results next is a major explosion in the CapEx spending across all of the board. So the CapEx spending between most of the Mag 7 companies have now exceeded $330 billion in 2025 alone. And the race has gotten so heated.
The thing is, a lot of the short-term pricing, like investors don't like it when you spend too much on infrastructure and things like that, but this is how the companies are going to survive in the next era. So I'm understanding of why they're buying this stuff. If you listen to Jeremy Lafave, I think his name is, the way that he explains it is because these used to be like very asset light companies, but now they're buying, these servers, the semiconductor, whatever, this stuff. Now they're going to have to put in its depreciation, and so like their overall revenue is not going to look as good. So there might be a little bit of freak out because of that. But for me, this very intuitive, like, yes, AI is a new thing. You are going to have to spend money on the infrastructure for this, but it's going to set you up for the next, 5-10 years. So, I don't like how the US economy is always like very quarterly. Like you always have to have like this next quarter be better than the next one with revenue, and sometimes you do need to invest in your company to make it more sustainable in the long run, or better and more innovative for the long run.
They become blind and burn through billions of dollars. You can see right over here, Mark Zuckerberg, the CEO of Meta, said that he'd rather misspend hundreds of billions of dollars than be late to this super intelligence party. And
I had a project where I was making custom metaverses every month when Zuckerberg was trying to get his version of the metaverse up and running and people into it. So I understand why people are more leery of Zuckerberg spending a lot of money on AI because he's had a failure before. But as a CEO of a very well-known company, you can't just not try to do innovation and be on the next wave. Like sometimes you're going to fail, but you always have to be thinking about how are we going to stay relevant over time.
And true to their words, Meta plans to spend $60 billion a year. Google earlier announced they would spend $75 billion on AI. And then later on this year, they just recently announced a $40 billion investment into a new data center in Texas. And Microsoft followed up with $80 billion, and then Amazon saying they'll spend more than $100 billion, capturing this once-in-a-lifetime opportunity in AI. And the recent $15 billion investment, along with NVIDIA, into Anthropic.
And yet no one blinks when Amazon does it, because Amazon already has AWS, so it already has a lot of assets. Also, I had dinner in my... Hopefully, I don't have anything on my... Anyways, we're good.
Anthropic, giving the company a value of over $350 billion.
You don't want her to have your bone? Okay. fair enough.
And all of this capex spending is ballooning out of control. But here's the scary part. According to Deutsche Bank, the US economy would already be in a recession if it wasn't for all of this AI spending. So AI capex spending is literally propping up US GDP growth. It isn't hype money anymore. This is actually the lifeline of the S&P 500 and
So like it's good, but it's also like I got laid off in May, and it would feel better to be like, and then there's a recession. Parents, that's why I don't have a job. But you know, whatever, it's fine. It's better not to be in a recession.
and by extension, the US economy. This leads us to the core of the problem. If AI capex slows down, that means that earnings is no longer going to be growing, the stock market is going to go backwards, the US economy plunges into a recession, leading to a tightening of global liquidity.
No pressure, though.
And this is exactly what makes it risky. And in this report by JP Morgan, looking at the build out of data centers, you can see they estimate that it can go up to $5 trillion and in some cases $7 trillion. When you think back to the number, the Mag 7, which makes up 40% of the S&P 500, only brings in $1.7 trillion. So this is about 3 times the cost of all of those companies bring in all of that revenue. And the report summarizes it perfectly right over here. It says that with $650 billion of revenue, giving a 10% return on all of that build out, that's the equivalent to every iPhone user paying $35 and every Netflix subscriber paying $180 a month. So we can see why people are having a lot of concern with this huge spend on AI and some of the earlier valuations. To understand how interconnected the money flow is between these AI companies, I looked at this report by Bloomberg right over here.
Thing is, if they're bringing in 1.5 trillion or whatever, and they're spending 5 trillion, they're expecting there to be growth, and like the economy is always growing, and so they're expecting to be able to profit on this eventually.
When we first take a look at it, you could see that this is a complex web of different companies investing the same money into each other.
Okay, so we have AMD and OpenAI. I see CoreWeave, Microsoft, NVIDIA's in the center, Intel, Oracle, xAI, Figure AI, Mistral, NewScale. Okay. And Nebius. Okay. It's a little bit of a confusing diagram, but it's a big web of lies. I mean, of AI deals.
But in today's video, I want to break this down and go deal by deal so that we can understand what is happening. So let's examine some of the select deals in this complex web of AI deals. Let's start off first with NVIDIA and OpenAI. So here's NVIDIA right over here with OpenAI. Earlier this year, NVIDIA says they'll go and they'll invest about $100 billion into OpenAI. So what does OpenAI do? They turn around with that same money and they purchase GPUs, the chips from NVIDIA. NVIDIA goes and books that down as revenue. So the second deal is OpenAI inks a $300 billion massive deal with Oracle. So here's OpenAI. You'll see them come up a lot. Here's Oracle right over here, a cloud provider. So what happens is in that $300 billion deal, Oracle gets a huge amount of revenue, so it books revenue onto its book. What does it supply OpenAI with? Well, it provides OpenAI with their cloud infrastructure and upfront costs so that they don't have to build any data center. What does Oracle do with that money? Well, it turns around and it buys GPU from, you guessed it, NVIDIA. So the next deal is NVIDIA buying $6.3 billion of services from CoreWeave.
Yeah, so some of the stuff looks kind of bad on the surface, but if you like look into the actual deal, it's not as bad. I just haven't looked into it. But yeah, like this is how business deals go.
So here it is. Here's NVIDIA. Here's CoreWeave right over here. They go and they purchase that $6.3 billion. What is CoreWeave's core business? Well, what they do is they go and they purchase GPUs in bulk from NVIDIA. They build out their data centers and they rent those data centers to guess who? OpenAI and companies like that. The even more interesting part of this deal, if you go right over here onto the 13G, the filings with the SEC, you could see right over here, here's NVIDIA. And if you look down, they actually own 7% of CoreWeave. So by NVIDIA investing into CoreWeave, they are essentially paying themselves for booking that revenue. So the next...
Yeah, by the way, please like and subscribe if you like this kind of content. My dog would appreciate it. What isn't it right, Saja boy?
Deal is OpenAI agreeing to pay CoreWeave $22.4 billion. So here's OpenAI and CoreWeave. They pay them that money, that $22 billion. That $22 billion from CoreWeave is going to flow right back to NVIDIA buying their GPUs. And you guessed it, NVIDIA is going to be investing in OpenAI. So you could see why people are skeptical and they're a little bit more concerned of this circular financing that's flowing around between and among the companies. So the next deal is OpenAI agreeing to deploy billions of dollars into AMD. Recall that AMD is NVIDIA's direct competitor. They're number 2 in the market when coming to producing chips. So if you look at the deal right over here, here's OpenAI, here's AMD. They deploy billions of dollars into AMD. What do they get back? They not only get back GPU chips, but they also get equity into the company. Now, even Jensen Huang said that he was very surprised of this deal. If you look at this deal closely, you could see that they're getting up to 160 million warrants worth of AMD shares, giving them a 10% ownership into their direct supplier. And of course, the US government sees all of this going on at the same time, cites national security concerns because they're in an arms race against China to become the number 1 in AI. So they take a 10% stake in Intel, and then they claim a 15% of all sales of NVIDIA and AMD chips overseas. And of course, we saw this recent news with OpenAI completing its restructuring.
Okay, so I'm thinking about, do I agree with the US government taking a cut off of the sales of that? I'm unsure it's a good idea to be giving foreign countries, like adversaries, our technology, but you know, if you are, I guess you should, the US government could profit from it. And I do like myself some AI stuff, but they really are making it very difficult to tell what's reality on social media. So be careful out there.
And Microsoft having $130 billion into its profit wing, worth 27% of the stake of the entire company. So what we're watching and witnessing is not a new form of capital coming in. It's actually some recirculation within that AI economy. So you can't really blame people for being skeptical about the illusion of growth within the AI boom in industry. And we get people like Michael Berry from The Big Short. You remember the guy?
Yeah. I mean, like I said before, there was like that AMD deal, and it's not like they just got 10% of AMD. There's like performance goals, KPIs that they need to hit before they get the 10%. So it's like not as bad as it sounds on the surface, but it's still like we'll be skeptical.
Guy who shorted the financial crisis of 2008, coming out and calling this AI bubble, being skeptical about revenue recognition and calling it a fraud right out. Now, we all know that Michael Berry has a short position. He's announced it, but who knows what will happen in the near future. So another problem besides all of this circular spending is that where is all of this debt going? So in this part, we're going to talk about the SPV problem, which is where all of this debt is being hidden in plain sight. So let's first define what SPV is. So there's special purpose vehicle. They're basically a legal entity that allows you to finance specific projects and holds the debt off of the main company's balance sheet. So a very good example of this is xAI raising $20 billion from NVIDIA and other investors. You can see that NVIDIA invested $2 billion into this deal, with Jensen talking about being happy to be able to invest in Elon's company. So if we take a look at the fine prints of this deal, it's $7.5 billion of equity, $12.5 billion of debt that all goes into the SPV. The SPV turns around and buys chips from NVIDIA, and then xAI books those rental chips from the SPV. So I always understand these concepts a lot better with diagrams. So here's xAI, here's NVIDIA. They want to do this deal, but they can't do it directly with each other. They do it through this SPV. Now it's much more advantageous because NVIDIA can invest their $2 billion. The rest of the investors put money in, and there's the debt. But all of that is tied to the SPV. None of that debt ever shows up on xAI's books. So what happens is that the SPV will go and...
You really gotta love clever accounting practices. It's so interesting how people avoid the taxes. Yeah? Is that so?
buy that chip, those chips, those GPUs from NVIDIA. So booking revenue to NVIDIA, remember that NVIDIA invested this money and now booking the revenue. And then xAI right over here goes and rents it, then leases those GPUs, those chips. So all of that equity and especially all of that debt is basically hidden at a site from xAI's books. So the demand for compute power is real. The demand is there. But the financing of these deals make them look bigger, make them look safer, and make them look more attractive. So this is what they mean by the debt is being hidden in plain sight that you may not see on first glance.
This feels like when people are getting very hyper about return on capital. It's like, oh, you're just getting your own money back. And it's like, well, the IRS defines it like this. There's ways that fund managers can do accounting so that it's literally from the premium that you get from the cover calls. I'm talking about high income ETFs, by the way. So, like, it's the premium that you get from the cover calls, but if the value of the underlying went down, then it could be return of capital because of cool financial tricks, accounting tricks that I don't have first-hand experience with, but like SPVs are just, you know, tax defer whatever accounting magical stuff, and like if everybody knows about it, how hidden is it?
So at the center of all of this is OpenAI, the leading AI company and also the leading AI customer as well. If you take a look at their profile, even though they're a private company, they're valued at $500 billion, but they're only booking $13 billion of revenue.
OpenAI is gonna IPO at some point, and when like Adobe first came out, I was like, hey, Adobe's IPOing, maybe I should invest in it. And a fellow programmer was like, no, do not. And I didn't. But I probably would have done okay with it. But I think I would do options in OpenAI depending on how expensive the stock is when it hits the market. Like if it's a $50 stock, it's like $5,000 per trade. I think it would be interesting. It might wind up being one of the more popular ones out there to do options on, depending on how much the implied volatility is.
In terms of the projection. Now, if you think about it, OpenAI at $13 billion of revenue has went out and committed $1.4 trillion of spending. And that sounds ridiculous. Now, if you take a look at this interview right over here.
You know, OpenAI's revenues are still a reported $13 billion in 2025. And Sam, on your live stream this week, you talked about this massive commitment to compute, right? 1.4 trillion over the next 4 or 5 years with...
I think just in general, though, when, you know, the news cycle and everything is trying to warn you about like an AI bubble, it feels like the FUD machine of people trying to scare you out of something just so that the price will go down and they could buy it up cheaper. And then you get the next hype cycle and people are like, why weren't you in NVIDIA the whole time? And you're like, well, you know, there was a big news cycle and they said, get out of NVIDIA. And I got into NVIDIA and it was going down a bunch. But, you know, now it's up 300% or something stupid like that. So, I think also, like, even if you believe in AI and it'll have its moment, literally being in something that's a fund of funds and also a very small percentage of your portfolio, that way if something happens and all the stocks go down, you, like, your whole portfolio is not devastated. Not financial advice, just my opinion.
You know, big commitments, 500 million to NVIDIA, 300 million to AMD and Oracle, 250 billion to Azure. So I think the single biggest question I've heard all week and hanging over the market is how can the company with 13 billion in revenues make 1.4 trillion of spend commitments? You know, and you've heard the criticism,
First
Sam.
of all, we're doing well more revenue than that. Second of all, Brad, if you want to sell your shares, I'll find you a buyer. I just, enough.
That's kind of a funny comeback. Like, you know, if you want to sell, like, go ahead and sell. Like, you don't need an excuse. There are periods of time, though, that startups are not profitable. And at least OpenAI has a revenue, but it wouldn't be that surprising to me that, you know, maybe, well, the Mac 7 aren't startups, but you do have to spend a lot on the new technology in order to stay relevant. So it is what it is.
Like, you know, people are, I think there's a lot of people who would love to buy OpenAI shares. I don't think you would,
including myself. Including myself.
People who talk with a lot of like breathless concern about our compute stuff or whatever, that would be thrilled to buy shares. So I think we could sell, you know, your shares or anybody else's to some of the people who are making the most noise on Twitter, whatever, about this very quickly.
You can see from that interview that Brad asked him a very legitimate question. Now, like all other CEOs, I thought he should have explained it by saying something along the lines of, you know what, we're the fastest growing company. We hit 100 million users first, and now at 800 million users, this is why.
Kind of felt to me like he was joking around. Also, he probably gets this question a lot, and he may have just been like, now we're getting the sarcastic answer.
But he chose not to and got extremely defensive. But you could see that with this valuation and given the commit to spending, it's about 108 times revenue. Now, to see why that is so astronomical, imagine yourself running a small business and bringing in $50,000 a year. If you only bring in $50,000 a year and spend 108 times, that's about $5.4 million of spending. So you could see why Brad was curious and why he asked a legitimate question, because all of us would be wondering, how does the math work out? So is all of this AI spending and valuation out of control? Is this really the dot-com bubble 2.0? So back in the...
No. The dot-com bubble, it was a lot of things that were getting funding and they just did not have any business plan or models. These actually have like a customer and they're being used. So like there's a real use case for the AI nowadays. Now, that's not going to say like it's the musical chairs that we're playing, it's not going to come crashing down at some point. Sure, there'll be an excuse for something.
Early 2000s, with the internet bubble, there was tons of companies with no real earnings, everyone chasing the next big thing, and there wasn't demand at all. So prime example of this was Pets.com. They were one of the hottest business during that time. But if you look at their revenue, they only booked in $5 million of revenue while spending 10 times that amount. You could see that this was a recipe for disaster, and almost every balance sheet looked like Pets.com because there was no real demand that was there. And during that time period, hundreds of companies were popping up like Pets.com that ultimately resulted in the bursting of the bubble. If you take a look right over here, you can see that the NASDAQ from 2000 to 2002 lost almost 80% of all of its gains. And you can see it very clearly right over here that at that same time, all of these companies like Pets.com literally went to zero. We can see and learn from the lessons from the dot-com bubble that even great companies like Amazon during that time suffered a catastrophic loss.
In the year 2000, when the internet bubble burst, Amazon's stock in a very short period of time went from $113 a share to $6 a share.
You know, I wish that my dad knew more about investing. Because if he had been like, because when I was a kid, my sister convinced him to have us do chores. And so he made like a spreadsheet. And it was like the frequency we could do it and how much each chore was. And the deal was half of whatever we made had to go into our college fund. But I kind of wish that when I had my first job, my dad would have been like, hey, like, here's how you can invest in like a mutual fund or an individual stock, because the 2000 stock bubble did happen when I was, getting started with my first jobs. So it would have been nice having that habit going into college. Although I think the prevailing attitude is like your part-time jobs you have while you're in high school, may as well just save it up because you're going to just spend it when you're in college. So, but as a high income investor, I'm just like, invest it in like XDTE, SDTY, like SPY, whatever. Maybe get the money that you need to pay for food while you're in college or something like that, And plus, it's so much easier nowadays. Like, you don't have to go into the bank to request them to buy a stock for you or call it on the phone. You're just, like, I'm on Robinhood app all the time. And I can do fractional shares, which is also very nice.
Almost 99% of their valuation dropping from $113 to $6. And we could see right over here, going into July, August of this year was the first time that the tech companies exceeded 1/3 or 33% of the entire S&P 500. And the last time that happened was back in the 2000 dot-com bubble that bursted. And more than 50% of the companies did not survive this collapse. And of course, everybody thinks that it'll be different the next time around. Now, one of the things that distinguishes the dot-com bubble from today's AI bubble that we're seeing is we actually have real demand and applications. We can see that the number of users on OpenAI has exploded to over 800 million. If you compare that to the peers, you can see Gemini having more than 650 million users, Grok about 65 million users, and Claude about 20 million users. And we could see right here there are revolutionary applications of AI, just like Google's DeepMind AlphaFold being awarded the Nobel Prize in Chemistry for protein folding. And what it took biologists, scientists, and doctors to do within 50 years, they were able to achieve that with AlphaFold within light speed. And this is a huge leap in implication for medicine and science alone. It will help us understand a lot of different rare genetic diseases, how to fight cancer, how to approach drug testing, just a whole slew of application. So what are we as investors and everyday people supposed to do? Number one is that I think it's critical to recognize that there's some bubble behavior within the market and not just the technology.
Okay. Yeah. If you believe that there's a bubble and it's about to burst, maybe just don't be over concentrated in themed ETFs and then have a balanced 3-fund portfolio.
technology itself. As we've seen today, there's a lot of circular deals that are going on between 6-7 companies where the money is going within circles and then also the debt is being hidden out of our sights. We can certainly believe and see that AI will change the world, but at the same time, the spending is unsustainable. Those two are not mutually exclusive events. Number 2 is watch the CapEx growth in spending. It's one of the leading indicators. When CapEx starts to flatten out, you know that this bubble behavior is finally coming to an end. And don't assume that our accounts invested in an index fund is
Yeah, I mean, it's true about the CapEx spending when it slows down and then the depreciation hits the books. It's not going to be great for the market.
actually diversified from AI. Remember that every 40 cents out of the dollar that you put in is going straight into this AI. So one certainly has to be cautious when looking at the economy and investments overall. If we look at the P of all these companies, you could argue that you're actually buying the...
Yeah. On the other hand, if you're investing in all this AI stuff, when your job is finally taken over from, AI, with AI, at least you'll be getting an income or, be able to survive from your investments. So it's going to be interesting to see if the government will respond to AI taking all the jobs.
The company at a better valuation today than what they were 5 years ago. And if you wanted to make a comparison back to that 2000 dot-com bubble and burst, you could see right over here the four horsemen, which is Cisco, Microsoft, Dell, and Intel back then, were actually trading at 80 times their PE before the bubble bursting. And if you compare that to the Mag 7 today, the Mag 7 is only trading at 36 times the PE. And if you were paying attention this week with NVIDIA's Q3 earning calls, they blew the numbers out of the waters. But it wasn't so much the numbers, and it was what Jensen said. You can see right over here, he said Blackwell sales, their newest and latest chip, are off the charts, and cloud GPUs are sold out. Compute demand keeps on accelerating and compounding across training and inference, each growing exponentially. So he's saying that there's a lot of real demand that's there. We've entered the virtuous cycle of AI. The ecosystem is scaling fast with more new foundation model makers, more AI startups across more industries and more countries. AI is going everywhere, doing everything all at once. You've never seen the CEO of the largest company of the S&P 500 in the world making this bold and this aggressive statement. So every time I get nervous about a bubble that's happening, I remind myself this chart. Over the past 36 years, we had over 30 events, major events, like the dot-com bubble, the financial crisis in 2008, the war.
Yeah, I mean, it's cyclical, and drawdowns are healthy for the most part for the stock market. It does mean that I don't have enough money to retire, which is stressful, but it is what it is.
Wars that have been going on, 9/11, recent wars, COVID and everything else.
But as a high-income investor, even if there is a pullback, at least I'm getting distributions that I can then buy into stocks when they're lower. So having a plan before any of the pullbacks happen is good, and sticking to the plan once bad things happen.
Under the sun. You could see that with powerful and great investments into companies, like let's say, for example, Amazon, they will emerge from even a major crash. So in my mind, those 1,300 companies and those unicorns out there will be a lot of casualties of this AI bubble. But at the same time, if you're invested for the long term and you're into good companies and you're not doing degen stuff, I think you will come out on top. And the last thing is I want you to look over here.
Not do degen stuff. Why would we want to do not degen stuff? Yeah, don't do degen. It's sometimes the slow path is the only path that you won't lose a bunch of money.
Here, you can see that since 1949 to now, the bull markets tend to last 5 years, whereas the bear markets last for about a year. If you miss out on the bull market, you're missing about 250% gain, whereas the bear market is only minus 31%. Now, if you try to time the tops and bottoms, 99% of us would not be able to do it. So for me, I'm sticking with long-term valuable assets that will grow over time, and I'm not so worried about, what's the next AI bubble, the next tech bubble that's going to blow up. So that was a lot of things.
Yeah, if you're properly diversified and you're not doing too much degen stuff, then you don't really have to worry about the AI tech bubble, because, you could be in something other than the S&P 500, but that's pretty diversified. So even if there is a crash, it's still better to be in it, because just because the S&P 500 might go down next year doesn't mean that it's going to go down further than what it is right now.
Things to go over today. I hope that you guys learned something and you enjoyed today's video. So if you do, consider liking the video, subscribing, and I will see you guys next time.
Yeah, that was a really good, well put together video. Thank you so much. Tracy. Sorry, I was trying to find it. Thank you so much, Tracy, for recommending that I watch this video. If you all want me to watch something else, I'm taking commissions. I'll just comment in the description down below. What are your thoughts on AI? And I thought it might be appropriate to listen to this song today from Financial Philharmonics.
AI is the
And I would love to thank the first 9 subscribers to my channel. That's really awesome.
I saw a screen light up, another name gone off the board. They said it's just efficiency, but I've seen this pattern before. No notice, just silence. Coffee still warm at the desk. They trained a model overnight, and now it's wearing your vest.
So they're replacing workers at Amazon, even though the company is still doing well, and it's just because AI has become that good that they can replace a lot of these jobs that are normally more secure, and they're dumping a lot of the workers into the market at the same time. So this was after I got laid off, so I was processing AI took over my job.
Dude, it's not just you! The AI's here too! One by one, it's coming through. Tasks and roles, line by line. Ghost in the code, ticking time. Dude, it's not just you! The AI's here too!
And AI is getting better every single day, but sometimes you still get that uncanny valley and too many fingers. Although, maybe AI is just overrepresenting some birth defects because there's been an underrepresentation in history. Is that right? No, I'm being too philosophical. It's okay.
Copy, replace, simulate grace, synthetic
I'm just curious because AI is going to replace jobs, right? And then there's going to be new jobs that are created, but then how are they going to train the workforce? And is it going to be the same people that are doing it? Because, like, you know, the mechanic that's on the work floor of making an automobile isn't going to be the same person that's maintaining the robots that are doing the same job that the worker was going to do. It's way different training. So, and yes, I am on unemployment. This is my last full week, and then I have half a week. And they do, they have some programs that are approved, like I could go back to college for free, but the one that I want to do, which is the CFP, is not on the list. So, like, I can get something, but will it be useful? That's why I haven't done anything through unemployment.
Customer service, poetry law. Now it writes the brands for. It doesn't need sleep, doesn't take breaks, just harvest patterns from your mistakes.
Yeah, so AI is expensive now, but the companies are making their bets that it's gonna be more efficient in the end to have the LLMs and all this stuff make things for you instead of paying people. We'll see if it's just short-sighted, like who's gonna be able to afford to buy your stuff. Hi, baby boy. Hi. Hi. No. Yup. There we go. We're almost done with this video.
Be more creative, they used to say. Now the prompt decides your pay. Collaboration's a one-way link to a mirror that doesn't blink. Feel it. That hum in the wires, 1,000 silicon minds, rewriting the fire. Oh no, it's not just you! The AI's here too! Office!
Okay. I like this song, but I don't really have anything new to add for this. So in conclusion, for this video, it might be true that we're in an AI bubble. I just don't know when it's going to burst. So it's my responsibility in my portfolio to not over-concentrate myself in AI, which is difficult, like the value thinker said, because the S&P 500 does have an over concentration on well, the Mag 7 are all getting into the AI, so it's just really hard to escape AI, but it's just like not going too hard into things that focus, like ETFs that focus to AI, because when you do that and they go down, then your portfolio is trashed. So, and then just be really mindful of, well, are you, because like the AI stocks are more like risk on, type stocks. So do you have more value, things that have more cash flow, are steady eddy, not really going to go down with the market as much, or things like gold. And I mean, Bitcoin's also a risky speculative asset, so just saying that it's good to be informed and understand why people are saying there is a bubble, but don't let it influence you to like sell out of your positions if nothing, like, just rebalance because it's the responsible thing to do and not because you're being influenced with FUD. That's just what I wanted to say. Anyways.